Welcome to our first series of Niche and Hot Invest Talks to discuss and compare opportunities presented by fintech platforms, listed REIT and private equity platforms, and the pros and cons for investors. This webinar series is co-organized with Bridge Plus, a co-working platform of CapitaLand and supported by Singapore Fintech Association and the Blockchain Association Singapore. Bridge Plus will be launching a new center catered to the fintech community in Singapore at 79 Robinson Road in last quarter of this year. I'm the originator and moderator for the 11th series. My name is Ngee Hua. I'm a former venture capitalist under Far East Organization Venture Capital Arm as its founding employee. I'm a former merger and acquisition staff of Sembcorp Environmental Management, and I set up their first rep office in India. I relocated from Singapore to Australia, Japan, and China to work under Escort REIT and its private equity fund. Today, based in Singapore, I advise on cross-industry business strategy as intermediaries in fintech and alternative investments. I'm also the secretary of Singapore Fintech Association, which is partially funded by MAS. Throughout the webinar, audience are encouraged to post questions. Our first speaker representing the fintech startup is Cliff Ong, co-founder of RealVantage. Cliff has transacted over $3 billion across geographies, sectors, and entire real estate spectrum over 20 years. He has held senior positions at ARA Asset Management and headed investment management functions at Firmus Capital and Rockworth Capital Partners, investing for family offices. He graduated with a Bachelor of Science Real Estate from NUS and a Master of Philosophy in Land Economics from the University of Cambridge. Cliff, please.
All right, thanks, Ngee Hua. Let me just share my screen. All right, everybody can see it? All right, thanks, Ngee Hua, again. It's good to meet you again after all these years. Hi, everyone, and thanks for tuning in. I'm humbled to be on this panel discussion with two very esteemed speakers in the business, Gerald and Oliver. It's a pleasure to meet both of you, and hopefully we can meet up in person at some point. Right. Thought I would start, I thought I would kick off by sharing what spurred me to come on my own to start this firm. So I've been in the real estate industry close to 20 years and spent a large part of it in the real estate private equity space. So I was involved in real estate industry, managing real estate funds on behalf of large institutions, pension funds, sovereign funds, and family offices. And we invested in different types of assets across the globe. Ironically, when it came to investing my own money in direct real estate, I was not able to invest the way I did for my clients. I realized there were very limited options. I was confined to the local Singapore market, which offered pretty compressed yields of 2 to 3%. And when I started to look abroad, the options were also pretty limited. When you think about it, more often than not, when one ventures abroad to invest, invariably we end up buying apartments. And I imagine for many investors, their options are further limited because they may struggle with cross-border investments more than me. For example, the lack of time, local market knowledge, regulatory and tax issues, industry connections, and the hassle of asset management poses a lot of challenges for them. So my partner and I asked the question, how can we do this better for all of us? We knew there were better opportunities out there, but we can't just access them. So this is what RealVantage is all about, providing investors with a more systematic and smarter way to invest in offshore real estate. More choices, lower risk, and better returns for our capital. All right, in a nutshell, RealVantage essentially acts as your real estate fund manager, bringing you the benefits of direct real estate investing minus the hassles. We play three key roles, right? First, we source, we analyze, we rigorously underwrite real estate opportunities. Next, we execute on asset management strategies to create value and drive returns for our investors. So at the end of the investment period, we seek the best possible exit for our investors. So we do all this through our online platform. It allows investors to invest efficiently, transparently, without going through a cumbersome and time-consuming process. the onboarding process, the investment process, the asset management, the asset performance tracking, the deposits and distribution of funds are all done online. We see ourselves bringing value in the following ways. First, we believe we provide greater access to deals. Our deals cut across real estate value chains and capital structures. Deals which we believe individual investors do not have ready access to. For example, you could be participating in a joint venture with a developer to build homes, or you could be investing in a debt structure by providing loans to a developer. Secondly, our opportunities are project specific. So investors get to diversify their investment capital either by country, by sector, or by strategies. By strategies, I mean investors can invest, for example, in a stable yield-driven asset to a higher returns opportunity involving development. Next, with flexible investment ticket sizes, investors will get greater exposure to direct real estate investing while avoiding over-concentration risks, right? And finally, we actively manage the asset throughout the investment life cycle. So investors do not do all the heavy lifting, right? This is just an opportunity that we recently funded. I'd like to share with you. This is considered an opportunistic deal, a deal which is considered higher risk, but obviously it comes with higher risk as well. Higher returns come with higher risk. This project involves the development of 9 townhouses in Australia. On the mode investments, investors participated in a joint venture with a local developer in Australia. So RealVantage acts as what we term as a general partner. We look after our investors' interests and we work actively with the developers to achieve the returns. Our investors on this deal includes family offices and professionals such as doctors, pilots, bankers, so on and so forth. Next, just to highlight how we do it differently. Right? We are a small team and we cover many markets. To help us sharpen our investment decisions, we have developed an in-house artificial intelligence system. Thus, we're using technology to help us to aggregate data, harness new data. Well, essentially, the system helps us to provide new insights, assess faster, access more completely, with the aim to make better investment decisions. So our AI system comprises 4 components. We have a macro section that helps us to rank and select attractiveness of sub-markets, constantly tracking changes in the markets, alerting us of potential turning points. Next, we have a deal origination, helping us with a pricing estimator and comparable database. Next, we have something called a deal assessment, essentially greater insights into locational attributes of the assets to sharpen our due diligence. And next, we have something called a risk that helps us to, we created a more scientific way of quantifying risk and computing more accurate risk-adjusted returns. And finally, it's important to understand the concept is only as good as the team behind it. So at RealVantage, we have a combined experience of close to 100 years in 2 areas: real estate fund management, data science, and technology. Many of us have come from esteemed organizations such as GIC, ARA, Barclays Banks. In real estate itself, we have transacted more than 10 billion in real estate globally, across all sectors, across all strategies as well. We are privileged to have 2 esteemed industry veterans who sit on our investment committee. Anthony Ang is the CEO of a Singapore-listed REIT and also former CEO of a private fund in ARA. Mr. Richard Tan is a former CFO of Suntec REIT. So both these 2 gentlemen sit on our investment committee. Their role is to vet and approve deals before we put up for funding. All right, that's the summary of my brief presentation. Thanks. I'll just hand it back to Ngee Hua.
Thanks, Keith. Our VIP speaker today is Gerald YONG, representing market incumbent player. Gerald is CEO of CapitaLand International. CapitaLand owns and manages a global portfolio worth 132 billion, with presence across more than 200 cities in over 30 countries. The group's market cap is 55 billion, and please note that all figures are before the COVID-19 pandemic. Gerald is responsible for spearheading the growth of CapitaLand Group's real estate investment portfolio in international markets in USA, Europe, Japan, Korea, and Australia. He has long tenure with CapitaLand. Prior to his current appointment, he was Deputy Chief Investment Officer of CapitaLand and concurrently head CapitaLand International. He was also the Chief Investment Officer of the Escort Limited. He played an instrumental role in the IPO of Escort Residence Trust when he was the head of investment and asset management. Gerald, please.
Thank you, Ngee Hua. Thank you to see everybody. I believe there are some formerly friends and partners of CapitaLand. Thank you for participating in this seminar, and thank you to SFA for inviting me to speak in this seminar and share my thoughts and views. As much as I want to share insights from myself, but also obviously I'm very humbled to learn from the technopreneurs and the entrepreneurs here on this setting. So I enjoy this opportunity very much. Just to give, I don't have any slides, so I'll just chit chat a bit about what CapitaLand is, where we are, and what we are kind of moving towards in this area of prop tech, fintech, and in the context of listed product or private product. CapitaLand is today in many markets, and through its long history, obviously we have a more established platform, but nevertheless the market is changing rapidly. There's the advance of technology, and like many other traditional players in real estate, we have been and are constantly challenged and disrupted by new players. And in the area of technology, we are definitely feeling the threats of the disruption. So on an ongoing basis, the whole team of CapitaLand is definitely constantly looking at ways we can reinvent ourselves and ways that we can digitize ourselves. So if I can say right now, in terms of accessing investors, retail or institutional invest in our listed platforms, our listed REITs. We also got private funds whereby institutional can still access our private funds. We also have partnerships. We had and we are having partnerships with more likely banks with their traditional distribution network to high net worth individuals. It could be family office as well, or individuals. So they have to be accredited, sophisticated investors, and then they will participate in CapitaLand funds. We do not liaise directly with individuals at this point of time. Unless you come in the 100 million, then of course we treat you like an institutional investor. But generally we don't. So it's listed space and private space, funds or club deals or joint ventures. In terms of using the fintech platform to, let's broadly call it crowdfunding or peer-to-peer, or we have not actively looked at it. I think the management team is aware of such fintech options. Is still monitoring. There are also talks sometimes whether we will use the STO. I believe there was a question on security token offerings. We also look at DPO, direct public offering, which is not exactly fintech. That's more of a deregulation thing. So whether is it the traditional IPO, DPO, which is kind of triggered because of technology, and the more sophisticated STO that kind of is a response to ICO, which is really a cryptocurrency. I think we are studying all options right now because we are in a very regulated environment in Singapore. We are listed ourselves, and so I think regulation play a big part in shaping our direction and decision forward. So nothing concrete, but I would say that in general we are shaped. Whatever direction we take is shaped by regulation. So whatever we do got to be regulated. So things like ICO, block, cryptocurrency, digital currencies, which are not that regulated yet by the Singapore government. So obviously that would it's not something we'll jump at. The second thing we'll look at is scale, because for us, for anything to be cost effective is scale. So we look at frictional costs, intermediary costs, timeline, and all that from our perspective, as well as from the perspective of the investor. So I believe fintech platforms these days will serve the needs of the issuer as well as the retail investor or high net worth investor. The third thing we'll look at is actually access to what sort of capital, whether it's short-term, long-term, and all that, which is like, you know, core plus and all that. So that would shape our decision forward. I think right now, we know with the variety of talent in a fintech platform, I think such options will continue to emerge, and the authorities will continue to shape the product with them. For us as a traditional real estate developer, it's still falling back to basics. Our focus is still to source for deals well, to execute deals well, and to originate the real estate product, because that is the underlying product that makes money. At the end of the day, whatever platform we want to adopt will be win-win between us and the investor, and it'll be subject to those key factors I mentioned. Right now, in terms of fintech, we are adopting more internally in our property operations. And also we are looking at it actively to source for deals with using AI and robotics to comb the entire cyberspace for data points. So it could be just an AI engine that search for things on Google, and it could be it could be demographic data, it could be specific data from specific sources. So that is something we are studying. Nothing particularly applicable yet at this point in time, because there's actually a lot of challenges. You need a certain volume of data, you need transparent data in terms of the property world to actually make your AI work. And for machine learning, you need good data. Yeah. Actually, it's the data that's a challenge. Is the machine learning modeling is actually not the challenge at this point in time, based on what I hear from my AI team in CapitaLand. And we also got the retail business where you have the Capital Star, which is our loyalty program. I think that is the most developed in terms of data, because we have direct, like almost up to 2 million customer data in the Capital Star for shopping malls. The other data that we're collecting, obviously, is through the hospitality arm of Ascot. So we are concentrating on collecting and making sense of the data at this point in time, so that whatever AI or machine learning or the model, the algorithm that we can set up will be effective. Then the question is between outsourcing and insourcing. So we're at a kind of stage. I'm just trying to give everybody some color on what CapitaLand is doing. So we are digitizing, but we're doing in so-called more the internal operations, sourcing for deals, more upstream. Downstream, making available our investment assets and product to the investor world out there. I think we are, at this point in time, is still sticking to the traditional routes because of regulations and so on and so forth. I will pause here for any comments. Ngee Hua, are we good? You're on mute, Ngee Hua.
Although Oliver is our last speaker representing fintech startup, but he will catch up given he was former Republic of Singapore Air Force pilot. Today, Oliver is co-founder and CEO of Fraxtor. He has more than 10 years experience in commercial, industrial, and residential real estate investments. He holds 2 bachelor degrees, one in aeronautical engineering and one in accounting and finance. And he has 2 masters as well, MBA from Imperial College London and a Master of Science in Real Estate from NUS. He is also the regional chair of the Foundation of International Blockchain Real Estate Expertise. Oliver?
Hi, thanks, Ngee Hua. I'll just give me 1 second. I'll share my screen. Thank you so much for inviting me to participate in this webinar. Very good to meet Keith and Gerald, also Ngee Hua again. So a little bit of a background. I'm Oliver, the co-founder of Fraxtor. Fraxtor is a blockchain-enabled platform that allows investors to co-invest in real estate projects and funds. We provide investors access to global real estate markets through digitized securities offered on our platform to provide our investors with a hassle-free investment process. Minimum investment quantum can start from as low as 20,000. Unfortunately, we are only allowed to onboard accredited investors and institutional investors at the moment. So this webinar, whatever I'm presenting to you right now is provided for educational purposes and should not be misconstrued as an offer of investments, financial and legal advice. You're required to do your own due diligence before making any investment. Sorry, my compliance team helped me put this in. So I'd like to take some time to introduce the key personnel in Fraxtor. Rachel Teo is our co-founder, and she's also the executive director of the company. She has more than 20 years of experience in real estate development and investment, both here in Singapore and overseas. Her family's development company has been operating in Singapore for more than 50 years. For myself, I think Ngee Hua has already introduced me. Nothing more to add. Joyce Ng is our COO. She's an ex-banker, OCBC and SMBC, performing roles in credit risk and later corporate relationship management. She's in charge of operations and compliance at Fraxtor. Marcelo is our CTO. He has many years of experience developing IT solutions for financial institutions such as Barclays Investment Bank and National Australian Bank. He's also the co-founder of Maecenas, which is a pioneer in the asset tokenization space. So as you know, the capital stack for real estate financing has evolved since the global financial crisis. Banks are less willing to lend out a large portion of this capital stack like before due to Basel III rules on capital reserve requirements. And this has definitely created an opportunity space for private markets to fill. So we started this company back in 2017. That's probably where the height of the ICO was. More than 6 billion was raised in 2018. And we saw this as an opportunity for us to raise funds. But like most of you would know, most of the ICOs actually failed. A large proportion of them were really fraud or really unstable startups, which end up losing a lot of people money. So we thought of leveraging on this same technology to put quality products for the investors instead, and try to leverage on this technology to make it more widespread to the open market. So for example, the Fraxtor platform has the ability to digitally tokenize securities, which can represent equity, bonds, or debt. And using our blockchain system, we're able to provide low-cost, transparent, and instantaneous settlement. As you can see, the secondary market has been grayed out. We have the potential to offer that, but based on MAS regulations and the licenses that we have, we are not able to offer this service currently. So we concluded our first successful pilot last year. This was a residential development project funded by our co-investors on our platform. Investors came from both Singapore and Australia. The expected returns was about mid-teens. So this was a landed development project, which is expected to TOP sometime in Q1 to Q2 next year, depending on the COVID-19 restrictions. So the products on our platform caters to a wide range of risk-return appetites, well-suited for individuals or family offices who want to find quality investment products to build their own real estate investment portfolio. And like any financial institution, Fraxtor has KYC and AML requirements to fulfill under MAS regulations. But we have made this journey as simplified and hassle-free for our users. You just have to create an account on our platform, fill in an application form, and submit certain required documents. Our platform is also integrated to your SingPass to allow us to retrieve information from the government. After your onboarding process is completed, you'll be able to subscribe for our offerings and fund them through our escrow account. Earnings will then be channeled back to you through this account for you to either reinvest back onto our platform or to withdraw it. So that's it for Fraxtor's portion. Do get in touch with us if you want to open an investment account. Contact details on the screen as shown.
Thanks, Oliver. This is the Q&A sessions. We have Q&A questions from the audience right now, and also during the registration. We have already summarized some of the questions, and I would like to invite the speakers to answer. The first question is on space planning. The chic eateries are actually converted into community kitchens in the COVID crisis, and no one is licking their fingers at eateries anymore. So how is your space planning impacted in your commercial portfolio, such as investment space, returns, and capex? Do you consciously avoid malls or retail assets going forward? Maybe Gerald, can you start first? Gerald, we can't hear you, Gerald. Right at the bottom.
Sorry. Yeah. I think maybe I address on commercial planning. First, I think as a user, we are obviously having to adapt to a post-COVID environment. So there will be some rethinking of the way we manage our space. So for example, besides the hygiene requirements being elevated, we will also look into installing things like, Perspex screens so that we can use more cubicles and so on and so forth. So that's more on commercial planning. Are we going to all work from home? I wouldn't affirmatively say anything yet, but right now, I think it's all focusing on recovery and getting people back to the office so that we can gain some momentum in the recovery. There could be some long-term implications to use of space, but in any case, we are short of space right now for CapitaLand. So we are already short of space. So even if some of them work from home, I think we're still short of space. So on the second perspective, in terms of investment, I think for retail and hospitality, obviously we all know that they are under some strain now. So right now is for shopping malls, we have started to open. Obviously right now I'm thinking of optimizing and adapting to a new environment and to address the changing profile of the market and the customers. We are not going to jump at investing in a shopping mall, obviously. But in terms of hospitality, we are probably more selective in sieving out opportunities. Yeah. With this crisis, obviously, the other sectors, some of the other sectors like logistics and so on and so forth, and data centers have proven to be more attractive. So obviously, that has also piqued our interest more. Yeah.
What about Oliver?
So I think in terms of a retail space, a lot of these problems in retail space actually have been around for many years. It's not because of COVID-19, but COVID-19 did reveal a lot of all these fractures within this retail space. We have over the past few years seen a lot of retail space being transformed. A lot of tenants becoming, a lot of time the tenants are becoming more experiential type of businesses rather than retail type of businesses. So we already saw that before COVID-19. I do not think that COVID-19 situation or the current requirements by the government will extend in the long term. I don't think it will change so much. Humans are, after all, very social animals, and therefore will require, to go to F&B to take their food. They will want to go back to nightclubs. They will want to meet up with their friends. So I don't see a long-term change in terms of what we've already experienced in the last few years. We have seen, so personally, so Fraxtor doesn't invest in any commercial, doesn't offer any commercial retail space now, but personally, I am heavily exposed to the retail portion, and we do see a lot of strain in terms of our nightclub tenants, for example, in terms of our F&B tenants. We do see a strain. They have been shut down for the last 3 months, but a lot of them have also taken these 3 months while their business was shut down before the CB measures were put in, also to reorganize their business slightly. So I do think moving forward in the near term, there will be some, this will be affected. But if you look at the asset class in the long term, it will be the same as the last few years, which is already on a downward decline. Yeah.
Okay. Keith, what do you think?
Yeah, I mean, I agree with both speakers. I mean, obviously, the retail sector has been undergoing structural changes even before the pandemic, as shoppers change their spending habits with the growth of e-commerce. But you think about it, due to the change in consumer behavior, the sector faces an oversupply situation in certain cities. The COVID-19 situation certainly exacerbated the structural overhaul, right? Further declines in consumer spending, that's for sure. Therefore, many retail properties are just not coming back as successful as they used to be. So from a retail property prices point of view, we feel there'll be a reduction, right? From a firm's point of view, and that provides investment opportunities. From a firm's point of view, we believe well-located retail assets will always have a following. Retail assets will always have a lifestyle dimension that will stay. It's the asset management mindset that needs an overhaul to make the retail asset relevant for tomorrow, right? That includes relooking at the tenant mix, amenities, types of tenants, and even exploring conversion to alternative use. I think these are all structural changes that developers and landlords have to grapple with, right? We used to think about, oh, okay, F&B in a mall must be not more than 25%, but this has changed drastically. You look at Funan Mall now, almost 50%, I think. That's what I think. So there must be a mindset shift, and yet sufficient enough for us to make money out of it all. That's my take.
Yeah. If I, Ngee Hua, if I can just jump in to supplement what I said just now, just to a more direct answer to your question about impact to commercial planning. In terms of retail business, as in shopping mall, to put it simply, in China and Singapore, actually CapitaLand has accelerated our efforts to really go into e-commerce. So we actually, it has been announced in Singapore as well. We have done the Capital Mall online shopping and also Capital Mall treats, whereby you can order food basically. That means we're arranging food delivery. So we actually made the e-commerce marketplace. We're setting a marketplace for Capital Mall tenants to carry out their e-commerce activities online in the Capital Mall marketplace. Which, to put it simply, we're talking about omni-channel now. I mean, it's all about omni-channel. There's no single channel. So like to address what Keith said, the physical space is still relevant, but the online channel is also getting relevant, and COVID may come back. So I think it's about being omni-channel access and allowing online to offline, offline to online, and a mix of both. For example, you can order online and you pick up at the store, or you can shop and browse online and then you go into the store to buy. So we don't have to be so fixated about online and offline killing each other, but rather cohabiting forever and ever. So it'll always be an omni-channel availability, just that the percentage probably e-commerce will grow. Yeah, so that is the omni-channel efforts that CapitaLand in China and Singapore has been, actually, to be very honest, it has accelerated a lot just in a matter of 2-3 months. Because a lot of traditional retail tenants, you'll be surprised, actually they are very resistant to e-commerce. So actually, because of this COVID, they are also compelled to jump into the online. It's not just we as a traditional landlord. A lot of tenants are also traditional. Yeah, I'll stop here. Thank you.
Okay, thanks, Gerald. Thanks for further insights on, especially and including for China market, which is huge. Okay, the next question we had is on GDP. The OECD latest estimates show that the lockdown will directly affect sectors amounting up to 1/3 of GDP in the major economies. And for each month of containment, there will be a loss of 2% points in annual GDP growth. However, how are tech investments, especially technology-aided investments, faring during the COVID-19? Can I have Keith to speak for this?
Well, thanks for that question. You know, it's a hard question. I must say, fundamentally, And the impact of an investment is based on the economic performance of the country and the market. That's whether tech or no tech, that's fundamentally that, yeah. Tech-driven companies do, to some extent, use technology to find what we call an alpha, to systematically seek out an alpha, right? But really, we are all fundamentally still driven by how the market performs, right? Economic conditions and markets are fundamental to how the investment performs, right? Same for Singapore. You know, we're going through very difficult times. We might experience our most severe downturn, right? Investments, whether is it technology aided or not, will likely be negatively impacted one way or another, right? So for us, we are cautious when we look at investments. We have to be cognizant of the wider environment. Interest rates, particularly for investments, are very important. How the economic performance are also very important. So that's what I would sum up to say. I mean, fundamentally, it's still determined on how the economic conditions and the market performs, right?
Keith?
You mean Oliver?
Oh, sorry, Olivia. Yeah, Oliver.
Thank you.
Yeah.
Yeah, sorry. I share Keith's sentiment. You cannot fintech your way out of a bad economy. Fintech is not the solution to get out of the bad economy. The economy, I mean, being a real estate investor, you would know that once your tenants stop paying you rental, you are definitely impacted in terms of your own repayment, your own cost of capital. I'm sure CapitaLand knows that he has so much assets. I hope that you have given out a lot of concerns to your tenants, and that definitely impacts the bottom line for the company. So there is no way I feel that we can fintech your way out of it. If for example, if the economy starts to recover, then therefore, yeah, you can still see, you can see fintechs bringing some value back into the economy. But right now, everything is down. We just have to live through this period and survive through it. So that's my opinion.
Gerald?
Yeah, I mean, that's definitely, we can't fintech out of this, except that I suppose technology has shown kind of what connected to what I said earlier. I think all these e-commerce channels, even like virtual communications. For example, we are now doing leasing up in our US multifamily portfolio, doing virtual viewing. So there are people who actually sign up to an apartment just looking at the virtual video. So it is happening surprisingly. So these are real technologies, very practical, simple technologies that help us continue to be connected to the customers. I think that's the most important. You may not strike enough business to compensate for the loss of the business, but I think keeping the relationship and contact point with your customers and partners through all kinds of technologies, including fintech, is important now. I think that could differentiate the winners from the losers post-COVID.
Thanks, Gerald. I think we have poll questions coming because of interest on space planning. We have a poll questions. We'd like the audience to participate in the poll, and we can see the results together on space planning. Yeah, during my conclusion of this session, can we have the poll questions for the audience? To conclude, both fintech platform and traditional platforms have their pros and cons, depending on the risk profile of investors and their investment appetite. The fintech platforms offers wider access to institutional type of private equity deals for investors in an affordable bite size at potentially higher returns compared to a listed REIT. The fintech founder use their human intelligence as opposed to artificial intelligence to pick up investments choices, while deal sourcing and due diligence are AI enabled, and transactions are blockchain for traceability. Fintech platform has also allowed unlisted real estate developers to raise development funds, and in future there might be secondary market for better liquidity when MAS gives his blessing. The listed REIT platform offers almost instant liquidity, transparency, and regular dividends income stream compared to all other platforms as of today. The private equity platform is catered mainly to institutional investors with higher return and risk profile compared to listed REITs, but also offer through channels like Bank of Singapore for high net worth clients, which some of you are. As market incumbent, CapitaLand is also proactive on technology fund and is not losing out on the fintech challenges. He's exploring using AI to help in deal sourcing and is aware of security token, but not in it. In terms of skill, they are still evaluating the skill of this securitized token. And for operating the business, CapitaLand has leveraged and made some prop tech investments and fintech to a certain extent. And within CapitaLand, he has 2 million of customer data from his malls, as well as in the hospitality arm, which are very, very valuable and available to be harnessed. And in terms of the people managing the real estate investments, we see quite similarities between the traditional as well as the fintech platforms. The platform is fintech platform is either managed by former private equity professionals like Keith, or one with property developer background like Oliver. So on GDP and the global economy has no doubt affected most businesses, and fintech is not immune. Market incumbent player believes that machine learning has is not able to achieve its maximum potential, given that we do not have pandemic data to deploy machine learning. And for more complex deals, you have to have you need site visits, but traveling is limited. And virtual videos continue to use virtual videos to stay connected to the customers. And the on space planning, the impact to land on market incumbents are adding screens for workstations, and they are in fact very short of space. So that's not an issue with too much space. Slower returns and not jumping on acquisitions either. And it's also difficult for credit market to restart. But there's a lot of opportunities, they believe, for distressed hospitality assets to acquire. Office is everybody's guess, and some say it's decentralization. We have Facebook, Twitter promoting work from home. Data centers is interesting, and because of working from home and e-commerce is increasingly interesting. And for China and Singapore, especially in the last 2 months, CapitaLand is on the ramp up in creating an e-commerce market space with CapitaLand Treats, and only channels is the way to go, because it's recession and COVID-19, all the disease proof, because you just switch between the proportions between e-commerce and online offline channels. While the fintech startup is not active in retail space, they felt that social interactions are part of life, and itself the sector is already facing structural challenges, and therefore retail will ultimately pick up, but the structural challenges need to be tackled, and new strategies are needed to change or alter retail space to other use or more relevant use now and in future. So yeah. Unfortunately, we don't have enough time to answer all the questions, but we will try to answer some of the questions via the LinkedIn or through our channels separately. Thanks very much for being here. We look forward you to join us for our future niche and hot Invest Talk channel in the following months, and finally to meet you in person in one of our series at Bridge Plus at 79 Robinson Road. CapitaLand's new flagship building due to be open in last quarter of this year. As the space ability is actually restricted during COVID-19, as you know, priority will be given to those who attend all the series prior. Thank you, Gerald, for being our first VIP speaker. It's our great honor to have you. And also to our promising startup founders, Tim
It's a
and
pleasure.
Oliver. Yeah. And the man behind the scene, Eugene, Dominic, Timothy, and lead by Marcus. We'd like to thank Bridge Plus for co-organizing this webinar series. Bridge Plus is the community development and co-working platform of CapitaLand with a focus on creating communities and industry tribes through flexible workspace and shared facilities across Singapore, India, and China. Goodbye, please rate me, the speakers, and the events before you log off. Thank you.
Thank you very
Yes,
much,
sir.
Ngee Hua,
Yes.
for putting this
Thanks.
together. Thank you.
Thank you.
Appreciate it.
Thanks,
you.
Ngee Hua.
Thanks,
Thank
guys.
you.
It's a pleasure.
Thank
Yeah.
you.